Most Australians overpay their tax by thousands of dollars every single year, not because they want to, but because they have absolutely no idea what they're legally allowed to claim. The Australian Tax Office collected over $670 billion in taxes last year, and a significant portion of it came from ordinary workers who never used the legal levers sitting right in front of them. Today, I'm going to walk you through 8 legitimate ways Australians pay almost no tax in 2026, every single one of them legal, every single one of them backed by ATO rules, and every single one of them used quietly by people who actually understand the system. Let's start with the foundation. The 2025 to 26 tax brackets in Australia look like this. The first $18,200 of your income is completely tax-free. From there, it rises in steps 16 cents per dollar from $18,201 to $45,000, 30 cents from $45,001 to $135,000, 37 cents from $135,001 to $190,000, and 45 cents above $190,000. Add the Medicare levy of 2% on top of that for most people. The single most important thing to understand is this. The ATO doesn't tax your income. It taxes your taxable income, which is your income minus every legal deduction you can prove. And there are a lot more of those than most Australians realize. Let's go through them. Number 1. The single biggest legal tax lever in Australia, concessional super contributions. Right now, the concessional contributions cap for 2025 to 26 is $30,000 per year. From 1 July 2026, it rises to $32,500. This includes your employer's compulsory 12% super guarantee, but anything you contribute on top of that, up to the cap, is taxed at just 15% inside super, instead of your marginal rate. If you earn $100,000 a year, your employer is contributing $12,000 to super already. That leaves $18,000 of the cap you can salary sacrifice. If you do, you save 15 cents on every dollar going from a 30% marginal rate down to 15%. That's $2,700 in tax saved in a single year. Repeat that for 20 years, and the compound effect is genuinely life-changing. And here's the part most Australians don't know. If your total super balance is under $500,000, you can use the carry-forward rule. You can use unused concessional cap from any of the previous 5 years. That means if you've been under-contributing, you might have a buffer of $50,000 or more that you can use in a single year to wipe out a large taxable event like the sale of an asset or a big bonus. Number 2. Work from home deductions. The ATO offers 2 methods to claim home office expenses, and most Australians pick the wrong one. The fixed rate method gives you 70 cents per work from home hour, covering electricity, internet, phone, and stationery. The actual cost method requires you to calculate every individual expense, but for higher earners with a dedicated home office, it often delivers a much bigger deduction. If you work from home 3 days a week for a full year, that's roughly 1,250 hours. At 70 cents per hour, that's a deduction of $875. At a 30% marginal rate, that puts $262 back in your pocket. Small in isolation, but stacked with everything else, it adds up. Number 3. Self-education and professional development. If a course directly relates to your current job and helps you earn more or perform better, you can deduct the full cost. That includes course fees, textbooks, internet access, depreciation on your laptop, and even travel to and from classes. A $5,000 MBA module for someone on a 37% marginal rate returns $1,850 to you at tax time. The key word here is current job. The ATO is strict about this. You cannot claim education that's getting you into a new field. But upgrading skills in your existing role is fully deductible. Number 4. Work-related vehicle and travel. If you use your personal car for work purposes, not commuting, that's specifically excluded, You can claim either using the cents per kilometer method, 85 cents per kilometer, for the first 5,000 kilometers, or the logbook method, which lets you claim a percentage of all your car running costs based on a 1-2-week logbook of business use. For someone doing 4,000 work-related kilometers a year, the cents per km method gives a $3,400 deduction. The logbook method, for someone with a more expensive car or more business use, can easily double that. Number 5. Charitable donations to registered DGRs. Donations of $2 or more to deductible gift recipients are fully tax-deductible. This is one of the cleanest ways to lower your tax bill while doing something genuinely good. If you donate $1,000 to a registered charity and you're on a 37% marginal rate, $370 comes back to you at tax time. The charity gets the full $1,000, the ATO foots part of the bill. Number 6. Prepaid deductible expenses. This is the strategy small business owners and self-employed Australians use to legally compress their tax. Under Section 82 KZM of the Tax Act, you can prepay up to 12 months of deductible expenses, interest on investment loans, professional subscriptions, insurance, courses, and claim them all in the current year. If you have an investment loan and you prepay 12 months of interest before 30 June, you bring forward potentially tens of thousands of dollars of deduction into the current financial year. For high-income earners, or for years where you've had an unusually big income event, this is one of the most powerful legal moves available. Number 7. Investment property deductions. Owning an investment property, even one that's negatively geared, gives you access to a long list of legitimate deductions: loan interest, council rates, land tax, property management fees, insurance, repairs and maintenance, depreciation on the building and on the fittings and fixtures. The depreciation alone on a newer property can be $5,000 to $15,000 a year in deductions you didn't actually have to spend cash on. That's why a properly structured investment property can be cash flow neutral or even positive after tax even when the rent doesn't fully cover the mortgage. But remember, from July 2027, negative gearing rules are changing for new property purchases of established homes. So the window for this strategy on established investment properties is genuinely closing. Number 8. Income splitting through a spouse or family trust. If you're married or in a de facto relationship and one partner earns significantly more than the other, there are legal structures that let you redirect investment income to the lower earning spouse. A spouse super contribution can earn you a tax offset of up to $540 if your spouse earns under $40,000. Family trusts are more complex but extremely powerful, particularly for business owners or anyone with significant investment assets outside super. Trust distributions can be allocated each year to the beneficiary in the lowest tax bracket, which can dramatically reduce overall family tax. But these structures cost money to set up and run, so they make sense at higher income levels, typically $200,000 plus per year, and they require proper professional advice. So let's put this all together with a realistic example. Imagine a 40-year-old Australian earning $120,000 a year. Without optimization, they pay around $29,000 in income tax, plus Medicare levy. That's their default. Now let's apply the strategies. Salary sacrifice $15,000 into super saves them $2,250 in tax. Claim work-from-home deductions of $1,000 saves $300. Self-education course costing $3,000 saves $900. Work-related travel and equipment of $1,500 saves $450. Charitable donations of $1,500 saves $450. Prepaid investment loan interest of $5,000 saves $1,500. Total legal tax savings, $5,850 per year, from $29,000 down to $23,150. That's not a tax dodge. That's not a loophole. That's an Australian who actually understands the system the ATO publishes for everyone to read. The ATO is not the enemy here. Every single one of these strategies is published openly on ato.gov.au. They exist because the government wants to encourage retirement savings, education, charitable giving, business investment, and home office productivity. You're meant to use them. The system is designed for people who do. The Australians who pay the most tax aren't the ones earning the most. They're the ones who never learned how the system actually works. And every dollar you save legally is a dollar you can compound, invest, or use to build the life you actually want. As always, this is educational content, not financial advice. Tax rules are complex, and your situation is unique. Always speak to a registered tax agent or licensed financial advisor before making decisions, especially before setting up trusts or claiming significant deductions. If this gave you a clear, honest picture of how to legally lower your tax bill in Australia in 2026, subscribe, because next week we're revealing what most Australians don't know happens to your super after you hit $100,000 inside it. See you then.